Neel, you have a very interesting resume. The saying has it, you don't have to be a rocket scientist to understand this, but you are actually close to a rocket scientist. So let's start there. And then you went into banking. You were one of the architects, or if not the architect of TARP. You were in PIMCO, and now you're the president of the Federal Reserve here in Minneapolis. So just give us a short run of your, what's your life about?
Well, first of all, thanks for having me, Marcel. It's great to be with all of you, so thank you for inviting me. I'm always looking for things that I find are enormously challenging and what I consider to be enormously important. So when I went to Treasury, I was at Goldman for 4 years after business school, and President Bush picked the CEO, Hank Paulson, to become Treasury Secretary. Basically, I cold called him. I'd met him once. I was working in California, and I said, I want to come work for you. I don't care if you want me to lick envelopes. I just want to serve. And people at Goldman thought I was crazy. You know, you're early in your career, you're doing really well, you still have your student loans, you're going to give all that up to go work as an aide to the Treasury Secretary, you're out of your mind. And I said, you're crazy. This is a once-in-a-lifetime chance to get to serve, to learn something new. What's the worst that can happen? I don't like it, I go back to the private sector. None of us saw the financial crisis coming. If I had known, maybe I would have rethought it. But it was an extraordinary experience, and I found that I love public service, and it draws people in who have this kind of common element, and that's certainly true at the Federal Reserve again. And so I jumped at the chance to join the Fed because it's a chance to hopefully positively influence public policy for our region, for our country, make a contribution, and work with other people who have that in their veins, in their DNA. And so there's been no plan to my career. It's just been pursue something, hopefully do it well, and if I do it well, it'll open doors to other opportunities, and that's certainly been true.
Okay. So you ran for governor of California. You came in at a very respectable second place as a Republican behind a Democrat.
There's no prize in an election for second place.
Yeah. But, you know, the issue, because that has pushed you to, you know, have all sorts of statements out there as to what you stand for. You know, you're on record saying, I'm a supporter of Dodd-Frank, and I'm not sure that it goes far enough. I'm paraphrasing this, and you know, leave it to you to fill that in. Any regrets over what you've done over the last 15 or 20 years?
None. I mean, I ran for governor of California the same reason I joined the Fed. It's a chance to try to influence public policy, and being governor of a state is one way to do that. Being a Federal Reserve Bank president is a different way to do that. But it motivated me, the same motivation. And it's funny, if you go back and look at my campaign for governor, my slogan, I had a slogan, my slogan was literally jobs and education, that's it. I ran on an economic agenda, and I feel like at the Federal Reserve, in many ways, we're advocating for the same economic principles. How do you create opportunity for people? How do you have an economy that's growing where everybody can participate? And so I have no regrets. I mean, I wish I won, obviously, but other than that, I feel very good about the campaign that I ran and the principles that I ran on, and I didn't compromise 1 ounce. And I think that served me well.
Is it fair to call you or to characterize you as socially progressive and fiscally prudent?
I think that's fair. That's how I would. Maybe not everybody would agree, but that's how I would look at it.
So my last question on you is am I fair in assuming that we have you on loan here in Minneapolis for a while?
Well, I'm not, I mean, everyone thinks because I've done different things that I'm, you know, itching to pull the trigger and, you know, make a future move, and that's just not true. My wife and I live in Orono, not far from here. This is a wonderful community. It's a great place to live. Quality of life is very, very high, and I find the job very challenging and engaging, working with great people, meeting interesting people. So I hope to be here for a long time.
Okay. So let's talk about banking. There's a lot of people in the room who have an interest in banking and what goes on in the banking industry and restructuring and reform. Whoa, that's the light going out. Shall we? Oh, look at that. I was just wondering whether or not we should pause or continue. So, you know, so you've been on record saying that some of the banks after Dodd-Frank are still too big to fail. And the first question that comes to mind is: do you still have friends in the banking community, or have they you know, expelled you to Minneapolis?
Some have expelled me. True story. Some of my good friends are really angry that I came out and said the biggest banks are still too big to fail. Others understand that I feel like my job is to identify risks, whether it's popular or not. We have to call it out and come up with proposed solutions. And so 2 years ago, we started a process to look at Dodd-Frank and have we done enough to address too big to fail. Our conclusion is we have not. In fact, we're about to release the final version of our plan. We've been working on it for 2 years. Basically, we need to double the capital requirements of the biggest dozen banks in America. And it's this simple. When my wife and I bought a house in Orono, our bank made us put 20% down. Now, why did they make us put 20% down? They made us put 20% down to protect the bank in case we run into financial trouble. That's what the 20% down is for. Well, we don't make big banks do that. If we made big banks in America put 20% down in terms of equity on their own portfolio, we would basically protect taxpayers against future bailouts. Right now, they have about half the equity that they need. And so our jobs, as I see it, are we can't control everything, but if we can identify the risks, do the analysis, put forward sensible solutions, then other legislators and policymakers can take it forward.
Okay. So maybe that's a good segue into monetary policy. I think it's fair to say that the monetary authorities around the globe, in Europe, in Japan, and in the United States, are conducting a never seen before, I wouldn't call it experiment, but the policy has been very expansive. And if this would be a plane, I would say the plane's full of passengers. The baggage department is bulging. We're flying on heights that we've never flown before, and fuel's running low. And the monetary policies or monetary authorities are going to have to get us back on the ground. Are you confident that we will be able to land this plane?
I mean, I think when you talk about this, the analogy you're giving is because of things like quantitative easing. So when the financial crisis happened, the Federal Reserve took interest rates to zero, and other advanced economy central banks. Yeah. Then the question is, are we out of ammunition? So then the central banks started buying up these longer-term bonds to drive down long-term interest rates directly to try to stimulate economic activity. So now we have this $4.5 trillion balance sheet. We have already begun a process of shrinking that balance sheet back down to more normal size over time. And the way we're going to do it is just as the bonds mature, don't reinvest them. Just allow them to gradually roll off and mature. So far, so good. I mean, the Federal Reserve under Janet Yellen's good leadership did a great job communicating to the markets exactly how we're going to do that. There's been no taper tantrum, as you may recall from a few years ago when Chairman Bernanke made some comments and the markets overreacted to them. So far, so good. Now, could we be surprised? Certainly. But right now, the bigger fear, right? The biggest fear people had when we embarked on QE, I say we, I wasn't here at the time, but when the Fed embarked on QE, was that it would lead to runaway inflation. The opposite has happened. Inflation has been too low, not too high. So is it possible we're going to be surprised with very high inflation around the corner? It's not impossible. But right now, the bigger concern is that inflation is going to continue coming in too low.
Mm-hmm. So you're confident about the U.S. Is that also feasible for the Japanese authorities? Because they're sitting on an even bigger balance sheet, and they're sitting on a much higher debt to GDP ratio, 200% relative to where the U.S. is.
Right.
It's about twice where the U.S. is, if I understand it correctly. So can they get off quantitative easing?
It's unclear. So this is, what's conflating right now are a bunch of, or getting combined, are short-term economic issues with big picture macro structural issues that drive economics. If you actually think about how do interest rates get set? The Federal Reserve and central banks move short-term interest rates around, but longer-term interest rates are set by all of us, by demographics, by productivity growth, by good places to find investment. And so if you look around the world the last 40 years, interest rates have been gradually declining, and central banks are managing interest rates around that trend, but we're not the ones setting the trend. So if you look at Japan, Japan's biggest challenge is that their population is shrinking. And we don't yet know how to have a free market economy function in a shrinking population. And Japan, unlike in America, we're not having babies at the same rate we used to in prior decades. But we have had immigration as a big source of labor and consumers, which has been a big boost to our economy. Japan doesn't have that. And so the challenges Japan faces are much more severe than the challenges we face in America. And I don't know yet what the end game is for them.
So in an ideal world, Japan would be adjacent to Mexico, and they wouldn't build a wall.
Or bring in immigration from around Southeast Asia. There are lots of places. I think there are lots of folks who would enjoy the opportunities in Japan if their culture was more amenable to immigration.
Yeah. Are you confident that the gauges that you have in the cockpit are giving you the right information? Is the information timely? Is it late? Is it early? What's the biggest worry that you have? Maybe we're looking at the wrong dials.
You know, we get tons of data, and the harder part is not do we get enough data? It's figuring out which data to pay most attention to. And so I try to be very disciplined. If you look at just inflation as an example, there are many different measures of inflation. Some people criticize us that the inflation measures are mismeasured, and some people try to adjust it. You can tell any story you want, given the breadth of data that we have. So for me, I ask my researchers, and our research director, Mark Wright, is sitting back there, which is the single best indicators that we have, and let's be disciplined. And let's not jump around month to month to these different gauges, because then we're going to talk ourselves into a circle. And so for me, the single best measure of inflation that we have, it's not perfect, but it's the best we have, is looking at core, it's called PCE, personal consumption expenditures measure of inflation on a 12-month basis. That deals with some seasonality factors, that deals with short-term blips, and we can try to get a sense of the trend of where it's going, and it's been consistently low. And then last thing, and I'll stop talking, we look around the world. Low inflation is not just happening in America. It's happening in Japan, it's happening in Europe. That tells us, hey, this is probably a real signal. This is not just an aberration that we're mismeasuring it somehow.
Okay. So before I open it to questions, I just want to touch briefly on the Minneapolis Federal Reserve Bank. So the institution that you lead, you have about 1,000 people in your institution. So what do you do as an institution for Minneapolis? Question number one. And question number two, how does this institution link into the Federal Reserve in Washington?
Sure. Well, let me step back for a second and talk about why there is a Federal Reserve Bank in Minneapolis at all. One thing that's unique about our country is that we have this distributed central bank around the country. And this goes back to American history. Our country has always hated the idea of having a central bank, because it sounds very undemocratic. A bunch of bankers in a dark room, smoking cigars, doing God knows what. Just doesn't sound very democratic. And so Alexander Hamilton created the first central bank. They got rid of it. They created a second one. They got rid of it. And then the U.S. economy was hammered with banking crises in the late 1800s. And then a big one, the banking panic of 1907. So then Congress said, well, even though we hate it, I guess we need to have a central bank. But if we're going to have one, we're not going to keep it all in Washington, D.C. under the thumb of the president. We're going to distribute it. So there's the Board of Governors in Washington, D.C. They are appointed by the President of the United States. So President Trump just appointed Jay Powell to be the new chair of the Federal Reserve, and he's going through his Senate confirmation process. And then we have 12 regional Federal Reserve banks, including the Federal Reserve Bank in Minneapolis. And I'm not appointed by the President of the United States. I was not confirmed by the U.S. Senate. I was appointed by a local board of directors of business and civic leaders here. And that reason is Congress did not want the executive branch and the president to be able to control the whole central bank. So in a sense, the Minneapolis Fed is meant to be part of a check and balance on Washington. So we all work together, but I am meant to come to Washington and cast my vote for monetary policy or advocate my positions based on the best analysis we do here in Minneapolis. And it is meant by design to be independent from Washington, D.C. So we are doing our best to understand what's happening in our region, to do our own economic analysis, and to make the best recommendations we possibly can, independent of what may or may not be going on in Washington, D.C. at the time.
Okay, so going back to Minneapolis, what the 1,000 people that you lead, what do they do, and how do they link into the local economy?
Sure. So we do a bunch of different things. So all the reserve banks provide services to the financial system. So I just one simple example, you go and you put in your ATM card and you get cash out of the ATM. That cash started at the Federal Reserve Bank of Minneapolis. So we have Brinks trucks coming to and from our vault every day, taking new dollars out to all the banks, taking old dollars, processing them, shredding the bad bills, et cetera. We also provide different financial services and wire transfer services for the banking sector. In a sense, we provide the plumbing behind the financial system that allows banks to operate and to connect to other banks. They generally connect through the Federal Reserve. We also do economic research, as I talked about. And one of our missions, and I know this is common here, is we're always trying to look for thought leadership. We're always trying to say, how can we make a bigger contribution to our region or to our nation in terms of advancing smart economic ideas. And that's a standard that we try to hold for ourselves. And so, I'll give you a simple example. The city of Minneapolis recently voted to raise the minimum wage, and it just went into law. Well, the city of Minneapolis put out a request for researchers to study the effect of the minimum wage, right? Minimum wage increases are not without controversy. In some cases, they help workers. Some researchers say, well, if businesses just cut back the number of hours, then maybe workers aren't better off. So we put forward a proposal to study this on behalf of the city of Minneapolis over a period of 8 years. And our commitment is we're going to do the analysis honestly. We're going to get the data that we can from the state and from the city. We're going to do the best analysis using the best methods we have available to us. And we're going to publish it and let people poke holes in it. And hopefully we can advance the state of knowledge about what does minimum wage actually do for workers and for cities. And so that's a contribution I'm excited that we are going to make. The city has selected us. And we'll see over the next several years how it turns out.
Yeah, you have close collaboration with the academic society here in Minneapolis as well, I understand. So how does that work?
So we have a very strong partnership with the University of Minnesota. A lot of the economists at the University of Minnesota work with us. They come in and consult with us, and we go and work with them. We also have the board of directors of the business school, Sri Zahir, at the Carlson School of Management. She's on our board of directors. She's the dean of the Carlson School. She's on our board of directors. So we have a very close collaboration with the University of Minnesota in particular, but I think with all the research institutions around.
So we have a lot of quantitatively inclined people in the room. How can we as Cargill collaborate, and how can people individually here in the room collaborate, short of raising your hand like the way you did with Hank Paulson?
Well, I think we're always looking for economic intelligence. So one of the things that's exciting for me to be here at Cargill is you are obviously an enormously important global company with fingers in enormously important markets around the world. And so you can be a source for us of your own economic intelligence. What trends are you seeing? We're always trying to make sense of tons of data. What is signal? What is noise? I'm sure you all wrestle with this every single day in your various businesses. And so, I would love to just enhance the collaboration so that we can benefit from your own wisdom that you're seeing in your markets. And that could come from anybody across your organization reaching out, or it could come through you, Marcel, or other of your business leaders. But we'd love to, have that conduit and take advantage of it on an anonymous basis. And I won't attribute it in FOMC meetings that this came from you.
I am sure that people will be raising their hand. We will dissuade them from joining your institution because we actually are building up quantitatively inclined people. I'm going to open it up to the floor. We can go anywhere with this debate. You can take it very technical, but you can also take it very generic.
And don't worry about criticisms. I'm used to it.
Okay.
So we have a handful of microphones in the room. It looks like maybe I might just hand you the one I've got because I'm close to you.
Thank you. Good morning. My name is James Pierce, and I have a question about our digital banking system. So hopefully this is kind of a broader economics question. In many third world countries, it's understood that in order to really start to build wealth, you require investing systems, banking systems. And so the one that we have now, this distributed system that's distributing Bitcoin. And so my question is, I love your view on the viability of those types of banking systems to really start to bridge the divide of wealth between westernized countries. Marcel talked about Japan, U.S. And so kind of how do we bridge the divide between those countries that have wealth and those that don't?
Well, I think we're at the earliest days of trying to figure out what virtual currencies are going to mean for the U.S. or for developing nations. And Bitcoin could just be the first of 100 different flavors of ice cream, and maybe the 100th flavor has some special features that end up making it better. I don't know. We're all watching to try to see. There are anecdotes of countries like Venezuela turning to Bitcoin when their currency, faith has been lost in their currency. And I can understand that. In past, countries have adopted other currencies. So some countries went and said, we're going to just use the dollar, the US dollar, as our currency because people don't have faith in the country's own currency. Then the challenge becomes, how do they get enough dollars to feed their economy? And so It's certainly possible that these virtual currencies and the underlying technology could help spread wealth around the world and could bring stability to some of the, these less stable governments. It's just way too early for us to see, but I think we should all pay attention. And I'm not worried, by the way. I don't see Bitcoin as a credible competitor to the dollar in the United States of America. And the reason is the barrier to entry of you creating your own coin and me creating my own virtual currency and Marcel creating his own virtual currency is zero. So there are all these new altcoins being created every day. And while you may say, well, there's only so many Bitcoins that are ever going to be mined, if it gets muddled with all these other altcoins, you can still have inflation because you don't know which one to trust. And so I just think this has a long way of going before we know how this shakes out.
Talks a little bit about the plumbing that you just referred to. So when I came to the United States 9 years ago, I was very surprised that I had to make out checks. I had never done that. In my country, and everybody in the room knows I'm a Dutchman. Everything goes electronically. Is there still enormous investments that need to be done in the plumbing here in the U.S. in your view?
Well, there's a big project at the Federal Reserve to upgrade the payment system and have a next generation payment system. Yeah. And some people say that we're behind Europe and some other countries. For example, real-time payments. If you write a check, it clears after a few days. Why does it take a few days? But I got to tell you, me as a consumer, I don't feel it. And I'll give you an example. I had an old Chevy Tahoe, and I sold it on eBay for $5,000. And I met a guy at a gas station, and we met at the gas station. He didn't want me to go to his house. I didn't want him to go to my house, so we met at a gas station. He looked at the Tahoe, and he said, okay, it's as described. He pressed a button on his phone. I got a notice on my phone from PayPal saying $5,000 has been transferred to my PayPal account. Now, it may well have taken a couple days to clear in the background, but as a consumer, it was instantaneous as far as I was concerned. So I'm not sure that there's an active problem that we need to solve that technology is not already solving today. And I do still occasionally write a physical check once in a while, and I feel a little sentimental. I like writing a physical check.
That's the ultimate argument that trumps it all, of course. Okay, so I'm going to go back to the next question in the room.
So we have a handful of hands up. We have one in the back. So if you just give your name and maybe what you do real quick before you ask your question.
Absolutely. Good morning. My name's Ashley Davis, and I just want to ask you a little bit. You spoke about economic intelligence, and we've talked about everything from financial markets and some things that brought me back to college and times when I ran right out of that lecture hall because that's not the heavy part of my brain. But I'll tell you, I understand the importance of it, and I see how it impacts our world. And my question is, considering the demographics and the diversity of Minneapolis in this area, I'm just interested to know the type of technical assistance, outreach, and educational opportunities for those that are not so economically inclined or come from communities where it's talking about interest rates is pretty Greek to them.
Sure. Well, we have a lot of different programs to try to reach into our community and better engage with people, because historically the Federal Reserve was seemed to be very mysterious. It was very, I call it kind of a Wizard of Oz routine where don't ask us any questions, this is too complicated, you don't want to know, we don't want to tell you. That's been changing in the Federal Reserve, first under Chairman Bernanke and then Chair Yellen, and I know Chairman Powell is going to continue it. We want to be much more engaged with our community. So we have a community development department that actively works, for example, with nonprofits around our region to try to share what knowledge we have to bring it and technical assistance into their own communities. In addition, and this is a little related but different from what you asked, we've announced a major new research initiative at the Minneapolis Fed directly to try to understand and promote economic inclusion and economic opportunity. Because one of the big surprises I had moving to Minnesota has a lot going for us here. On average, we have very good schools. We have a very strong business sector. We have low unemployment. But that masks, those averages masks huge gaps, racial gaps, geographic gaps, et cetera. And we don't have a good understanding of what the structural reasons are underneath those gaps. So our new research center at the Minneapolis Fed is designed to try to unravel why are those gaps there and what can policymakers do about it. So engaging with our community is really important to us, both getting to know people and providing what assistance directly we can, but also doing the economic research to try to create an economy where everybody's able to participate.
So let me just follow up that, because you probably don't know, but I'm a volunteer at Junior Achievement. And I've been in front of a group of fifth graders trying to explain them what it is like to either be in a business or have your own business, which is hard. Because I'm used to people paying attention to me, and fifth graders don't necessarily do that. And so I'm going to drag you into one of those rooms to explain interest policy to fifth graders, and we'll see how that goes. There's many things that we can do potentially together in terms of educating people, so that's exciting, and that's. I think a lot of people in this room are aware of the achievement gap and the education gap. It's a huge issue in Minneapolis, and that's one thing that a lot of people in this room have a real interest in and trying to do something about.
That's great. No, we'd love to. We have our staff who go in regularly to different high schools in and around the Twin Cities to meet with kids and talk about whether it's financial literacy or planning for their futures, et cetera. So I'm not surprised that you all do that too, and I think we all need to do more.
Yeah, so I had the privilege of having lunch with you last week, and when I walked out of the business, a whole classroom of kids came in. So I initially thought, this, a parent here, one or two kids coming in, but then I saw that like 30 kids coming in, and I thought, no, that must be a classroom activity. Okay, next question in the room.
Oh, hi there.
Hi, my name is Jennifer Tong, and I'm a project manager here. I was glad to hear you talk about this initiative. I was fortunate to be at the Wharton Club presentation you did earlier this fall, so it was really good. And I have a follow-up to this whole conversation, really. I have started seeing this idea around out there with economists saying, you can't really understand economics in the U.S. without incorporating what might be called the psychological wage that white people earn in this country. It's not necessarily a dollar wage, but I think this was an idea that started with Frederick Douglass. And I'm a little bit curious to know if you see that idea gaining more traction, and if that is something that is starting to be incorporated or discussed.
I had not heard that, so it may well be, but I have not heard it. It has not come across my desk or my radar. But I will say one of the things that I find so interesting, being a non-economist, learning a lot about economics, is that psychology matters a lot. And so, I'm going to shift gears a little bit. It's not a direct answer to your question, but it's an example of this. The economic recovery has been slow. And we've all been frustrated by the very slow recovery, even with very low interest rates. One theory that resonates with me is that there is psychological scarring after the crisis. And I'll give you an example. Now, post-2008, I try to pay down whatever debt I have as quickly as possible. I don't want to have debt. I still have a mortgage, but I don't want to have debt, and I want to pay it off as quickly as possible. That was not true for me in 2006. I was much more comfortable having debt. It's fine. Everything's going to be great. But if you multiply my behavior times 100 million people or 200 million people, all of a sudden it really moves the needle on the economy. And so psychology matters a lot in the aggregate, and I imagine for different groups as well. Now, so I don't have a direct answer to your question, but psychology matters a lot in economics. Hi.
Hi. Hi, Nate Hansen, Finance. Thanks for coming. It's interesting to hear you speak.
Thank you.
So my question relates to the impact of interest rates on asset values. And so interest rates being low for quite a long time, and we've seen where the stock market is now, where homes are presently. And so I remember reading an article a few months ago when there was a vote and you voted to keep interest rates lower. You were, I think, in the minority with that. And so I'm curious what your thoughts are on that. Also, how that applies to wealth inequality, with those things primarily impacting people who own those kind of assets.
Yeah. So this is a topic that's a hot topic in social media, especially on Twitter. People get really worked up about asset prices and the Federal Reserve. And here's how I think about it. I remember a few minutes ago, I talked about how interest rates have been falling around the world over the last 30 or 40 years. That's not the Fed's doing. We don't actually control that. That's demographics, that's productivity, other macro factors. So when I look at the stock market, part of what I think is happening is the stock market is realizing this trend of lower interest rates structurally over time. We call it, there's a concept of a neutral interest rate, a long-term neutral real interest rate which balances savings and the investment in the economy. So to me, as asset markets price in this longer-term lower interest rate, that's partly what's explaining the higher asset prices, because they're discounting at a lower rate the same cash flows. And then there's optimism about global economic growth. Now, to the point about wealth inequality, even if I bought the argument that the Federal Reserve was responsible for a high stock market, and then that's magnifying wealth inequality, the thing I feel like that misses is we're trying to get wages up. So inflation has been low, wage growth has been low, so I'm advocating for lower interest rates to get wages up and to get inflation back to our 2% target. The single most important, the most valuable asset most people have is not their house, it's not their 401k if they have a 401k, it's their job. And we undervalue the value of a job in one's life. So if we're able to get wages up, the asset value of a person's job goes up. And so anyway, this is a long, circuitous answer to a very complex question. But the bottom line is I'm advocating for lower interest rates to get wage growth up, to get inflation back to our target. And if we do that, I think that will help workers and that will help the inequality that you talked about. And in an asset value sense, capitalize the earnings of somebody's job, and that's their most valuable asset.
So let me pull two things together. What happened here in Minneapolis recently with legislators ordaining a $15 an hour minimum wage, is, in your view, is that a good way to kickstart a wage inflation? And I know that, for example, in some European countries, governments are actually arguing that things are good. We should have some more wage inflation.
Well, my preferred way of getting more wage inflation is a strong job market where businesses have to compete with each other, and that pushes up wages. You know, when I travel around the region, every business, and I'm sure your business is going to say the same thing, our number one challenge is we can't find workers. We can't find skilled workers. Then the next question I always ask them is, are you raising wages? And the majority of them say no. And then I say, well, then you're just whining, right? Do you want more of something, but you don't want to pay for it? That's called whining in my book. So when I start seeing businesses actually bid wages up, that's when I know they're really serious about finding workers. And that lifts all boats when businesses are having to compete for workers. The challenge with minimum wage increases is there can be winners and losers. I mean, there's no question it helps the worker who keeps their job. But if it results in fewer jobs being available, then there are losers associated with that. And so I don't want to prejudge our own study that we're about to kick off. If you're raising a minimum wage at a time of very low unemployment, there are probably going to be fewer losers. If you did it at a time of high unemployment, then I think it would be probably more harm than good. So, we need to see.
Okay. The other question that I would ask in terms of psychology is, so we talked about psychology at a micro level for individual consumers, and you spoke about your own experience. What do you think of the psychology for politicians? Do they see that they have a put on the Fed and we don't have to worry all that much about deficits because, interest rates are going to be low and they're going to be low for a long time? Are you creating a moral hazard on that side?
I don't think this is the Fed. I think it's the fact that the U.S., because of the strength of the U.S. economy, the U.S. is the reserve currency for the world. The U.S. Treasury market is the deepest, most trusted bond market in the world. The U.S. government and the U.S. taxpayers benefit tremendously from having that privilege. So I do think that provides politicians an easy way out, because so far they can say, well, we can just run bigger deficits and markets don't seem to care. So I would say it is a problem. I don't think it's the Fed's doing, again, because we're only affecting interest rates in the short term. Long-term interest rates are set by these broader macroeconomic factors. And there's no question, longer term as a country, we do have to deal with our fiscal situation. We cannot, if you just forecast Medicare and Medicaid and Social Security, over the next 50 years, these things all go to astronomical levels. That's not feasible. At some point, we have to make tough political choices.
So over the last 8 years, we've gone through a slow recovery. And if you take a view on the inflation numbers being off a bit, maybe the recovery was a little faster than we thought. But let me just go back to what, in your view, is the role, if you'd have to attribute percentages to it? How much of it is monetary policy, and how much of it is it what the politicians are doing? If we would have had an extra % growth, would that most likely have come from what the politicians would have done over the last 8 years, or would it have come from what the monetary authorities have done?
Well, I think the Fed did what it could do. I don't think the Fed could have engineered faster growth by an even bigger quantitative easing, as an example. Maybe on the margin, a little bit. But where does economic growth come from? It comes from two major factors. One is productivity growth, and that's education and R&D, hard to affect in the short term. Second, it comes from population growth. More workers, more consumers, et cetera, and our population is growing more slowly. And so, sure, the fiscal authority could have done some type of fiscal stimulus, which would provide a temporary boost to the economy, but then we're going to go back to trend economic growth. And trend economic growth is productivity and population. And so, to me, I look at immigration and think if we get our immigration policies right to feed the economy, to meet the needs of the economy, that is the shortest lever, the quickest lever we have to try to get more economic growth.
Yeah, that's a nice line of reasoning where I think what we're arguing in the public domain around immigration is in line with what you're saying. So, next question, please.
Bruce Brummer in Corporate Archives. When I had economics at college in Minnesota many years ago, the one thing I sort of remember was that the Minneapolis Fed had this reputation as being somewhat of an outlier. And I'm curious if you would say that reputation or that characterization is accurate. And maybe original thinkers would be a better way to put that. And if that's true, what sustains that culture?
I think it is true. I think if you look at our research department, we have a lot of independent thinkers there, and I benefit tremendously from that. In fact, the Star Tribune wrote an article a few weeks ago about the process that we go through to approach monetary policy and to prepare me. And if you come in our meetings, our policy briefings, these are like intellectual wrestling matches and they're very respectful, but they're intense, where people are wrestling me, they're wrestling each other, everybody's bringing their best ideas. And so I think it's woven into the DNA of the institution, and I think it serves us very, very well. And it enables us to take these positions that are, in some cases, very different from people around the country. Whether it's on monetary policy, I was the sole dissenter last year in 2 of the 3 votes. Charlie Evans in Chicago joined me in December to dissent against the interest rate increase, or our stance on too big to fail. A lot of people were mad as heck that we did that. But I felt like if we were not speaking our minds about risks that we see, we would not be doing our jobs. And my response is, if you're mad at us, tell us where the analysis is wrong. We'll listen to that. But I'm not going to listen to just be quiet because it's inconvenient to hear us speak out. And so I'm proud of our institution for having that long-term reputation, and I think that it continues today. As long as we're taking on important issues in a nonpartisan manner and approach them with solid economic analysis, then I feel like we should take our best shots.
Okay. Next question, please.
Oh, hi.
Good morning. Thank you for sharing your insights. Lori Laughlin, I work in customer experience here, and totally not my field, this whole realm. So thank you for doing that. So you mentioned demographics and the impact on the long-term interest rates. You mentioned Social Security and Medicare and Medicaid rising. You mentioned workforce growth, right, as driving the economy. So the first baby boomers have just started to retire, right? We're going to see that bump coming. What should I, as an average Minnesotan, expect over the next 10 years or so in terms of our economy here?
Well, overall, we think real economic growth, so net of inflation for the U.S. economy, is somewhere in the low to mid 2% growth. And that's being driven by the fact that the population is not growing like it used to, and the fact that productivity growth in the last decade or so has been very low. Now, we could all be surprised. Maybe there's this big miracle of innovation that's going on that we don't really see it. It's not showing up yet in the data. I'd be surprised, but it'd be a great, it'd be great to be surprised in that way if all of a sudden there's this productivity miracle. So I would call it lower growth for the U.S. economy as a whole than in prior decades. But that doesn't mean that regions cannot have much faster growth. So it can be heterogeneity across the U.S. economy. And so what are the big competitive advantages that Minnesota has? Number one, we have a very educated workforce. Education is enormously important. You all know that. On average, Minnesota's schools are very good. We also have a very diverse economy. Most major sectors of the U.S. economy are represented here. So if any one sector is down, the other sectors are probably going to be covering for that, in a sense. So I think those are all strengths that we have here. So I think the outlook for Minnesota is very good, but we need to get the overall U.S. economy growing. And then I think immigration policy is going to affect Minnesota as well. We obviously have a lot of immigrants have been moving to Minnesota. I think that's going to be increasingly important going forward. Thanks.
Yeah, on the positioning of Minnesota, I'm building a house on the assumption that we're going to be the beneficiaries of global warming, and folks from California are going to come to Minnesota, with winters becoming shorter here. But okay, next question, please.
Hello. Yeah. So you mentioned how the US economy is enormously important to the global financial system. So I was wondering, how much consideration does the Fed give to the interests of the emerging markets when setting monetary policy here? So especially the interest rate hike that's being considered, and we know you aren't supporting that, but how would this impact the emerging markets and the capital outflow from them?
Yeah, so good question. We have to consider what's happening around the world, but we work for the US taxpayers. And so our interest is in maximizing economic outcomes for the US economy. Now, if we were to do something and all of a sudden it creates a crisis in emerging markets, that could affect the US economy too. So we do pay attention to what's happening around the world and what the likely feedback loops are. But our objective that Congress has given us, we call it our dual mandate. One is stable prices for the US economy, and the second is maximum employment for the US economy. That's our goal, and that's who we work for. And so it's to optimizing for the US, but aware of what the ramifications are around the world.
Next one, please.
Bern Moorhead, Cargill Risk Management. Thank you for coming to talk with us this morning.
Thank you.
You described the importance of clarity and focus on key indicators in a world of information. You also described the importance of rigorous debate. So how has your views of which key indicators and your understanding or interpretation of those indicators changed over time?
I'll give you an example. So one of the things that we talked about psychology, how important it is in economics. Expectations are also enormously important in an economy. What you think about the future, what you think about your own future, what your expectations are for the US economy as a whole. And so it turns out in inflation, one of the most important drivers of inflation are all of our beliefs about what's going to happen to inflation in the future. So inflation expectations. So we look at a bunch of different measures to try to get a sense of what are inflation expectations, where are they today? Because you're trying to read the expectations that are embedded in millions of people. It's a very inexact science. So there are market-based measures that we look at, and there are survey-based measures where consumers are asked a question, what do you think is going to happen to prices? And then they asked experts. There's a survey called the Survey of Professional Forecasters. Well, one thing that I figured out recently, maybe in the last year or so with the help of Mark and our other researchers, is when they ask the Survey of Professional Forecasters, where are inflation expectations? So these are professional economists. What I've realized is they're basically just reading back what the Fed is telling them, right? So we say our goal is 2%. So the Survey of Professional Forecasters are these PhD economists who crack open the book and say, hey, the Fed said 2%. So then they read 2% back to us. That's not very helpful. So that's an example to me of a indicator that gets a lot of attention that I've come to weight less because I think that they're just reading the answer in the back of the book. And so that's one where I lean more towards the market-based measures and some of the consumer measures who are not paying such close attention to the Fed.
So that's a follow-up from the metrics that we just talked about. And you referenced that maybe something is off with the measurement of productivity gains. Can you give us some examples of that?
Well, so people will say, well, look at your iPhone is so much more powerful than an iPhone 5 years ago or 10 years ago. Does the data economic growth measurement, does it factor into that? So if I spend $800 on a new iPhone and I spent $800 5 years ago on a new iPhone, is it really the same $800 or am I getting more value for that? And is that being captured in the productivity measurements? So that's an example where people think we might be underestimating productivity growth. But if we're underestimating productivity growth, then we're probably underestimating GDP growth. And there are a bunch of other measures that also have to be, you can't just change one of these. A bunch of other factors also change at the same time. And again, some of these things are global. Inflation is low around the world. Economic growth in the advanced economies is generally low around the world. And productivity growth is low around the world. So are we all making the same mismeasurements in the same direction at the same time? Or is productivity just really low? You know, if somebody invents a new technology, let's say here at Cargill, you invent a new technology, that technology can get adopted around the world very, very quickly. And so it turns out that productivity is becoming a global phenomenon. And the fact that we're measuring it low here, and we're measuring it low in Europe, and we're measuring it low in Japan, tells me it probably really is low. And by the way, I mean, think about what's the most important technology development in the last decade. In my opinion, it's not Facebook and Twitter. Right? These are rounding errors. You tell me, does Facebook and Twitter, is it productivity enhancing or is it productivity destroying? I think that's an open question. To me, it's fracking. Right? It's this energy revolution that has been driven by the U.S. economy. And so anyway, these are very complex topics, and we're looking at all the measures we possibly can. And if we're surprised that there's a bunch of productivity coming, that's a great problem to have.
Yeah, it has profound implications because if we have productivity growth wrong, and the math will say then either our inflation is lower than we think, or our GDP growth is higher than we think, and if our inflation is lower than we think, that would lead us to revisit monetary policy, and if GDP growth would be higher, then that would also give us a different view.
I mean, again, if inflation is actually lower than we think, then that's, I mean, in some sense, that's good because then we've got more room to run and we've got less to worry about this, all of a sudden, this inflation boogeyman taking off.
Good. I'm going to hand it back over to the group.
Sorry, I thought I was supposed to cede to the other side of the room there. Thank you for coming. My name is Roger Kemp. I work in the corporate finance group. I work on setting the WACC and then the corporate hurdle rates. One of the things that I've been interested in is we've looked at the benchmarking around other corporate hurdle rates is as leverage has gone up and interest rates have come down, the hurdle rates that companies publish for projects and those sort of things have remained relatively sticky. Now we've seen some acquisitions and those sort of things, but with that in mind, is there anything that's kind of surprising as you think about the models around where capital has ended up, you know, post-TARP and all these other liquidity measures?
Well, I'm not surprised. I mean, I do think the hurdle rates generally, anecdotally, are higher. And that's why, just a lot of discussion about tax reform and if companies repatriate, will that lead to all this new investment? I'm skeptical because these big companies that have these cash balances abroad can already borrow much lower than their hurdle rate. So if there are good investments to be made, they'd already be making those investments. Marginally reducing their cost of funds is not going to change those investment decisions. I don't have more of a view of it than that, but it is something we pay attention to trying to see what's going to boost investment in the U.S. economy and what's going to boost more growth. I mean, partly it comes back to confidence and optimism about the future, but I haven't seen any good analysis that unravels it or unpacks it.
But maybe that is a metric that you should be measuring. How do corporates respond in terms of their thinking about hurdle rates, so just as you pick up inflation expectations? Because it's quite interesting to see, and you've just stumbled into a huge debate that we're having internally about hurdle rates. Are we too conservative? Should we take our hurdle rates further down? And I think it would be a signal relevant for monetary authorities if, despite all the quantitative easing, the hurdle rates in corporates are not going to come down, because that means that people are not going to invest.
So let me ask you this. Okay, this is a great topic. So accept for a moment my argument that the markets are pricing in a lower long-term neutral interest rate. And that can explain high asset prices. So why aren't corporations pricing that in? Because shouldn't you lower your hurdle rate commensurate with this lower neutral cost of capital in a sense?
Well, I think why it's not being priced in is because there's a certain amount of conservatism, and you know, you and I have talked about this. I think people are saying, whoa, the patient is still very much on life support. So before we, you know, as indicated by the amount of quantitative easing that's coming through, so before we go off and say, you know what, we're going to take the hurdle rate from 9 to 8.5%. Let's take it from 9 to 6, and I'm just giving you the numbers of the internal debate that we're having. I think people are a little conservative because there is not. I don't think there's a lot of confidence that this economy has fixed all the issues that need to be fixed. And part of that is the signaling from the monetary authorities, but other part of it is what you've just mentioned. You know, there are some unresolved issues in terms of long-term financing of the federal government.
Okay, but let's take the monetary authority piece. So you're suggesting, and correct me if I'm wrong, that if we were to raise rates, implicitly raise your cost of borrowing, and then you would lower your hurdle rate.
You have just invited yourself into the debating room. The only thing that I am saying is, if you would gradually start increasing rates, I think people would say we're back into a more normal world. And that would, I think, drive confidence in boardrooms and would allow people to say, you know what, this feels a little more normal, because.
So here's where, I mean, I'm glad we're having this conversation. This is where it's not just up to us. I'll give you an example. So one thing that's happened over the past year is the yield curve has begun to flatten. So the Federal Reserve has been raising the short end, and the long end is basically not moving very much. So the yield curve is flattening, and the yield curve inverting is usually an indicator of somewhat of a forecaster of a recession to come. Whether it's a forecast of recession to come or not, set that aside. The fact that we can't control the long end is the economy telling us the clearing interest rate is lower than it used to be in recent decades. So I could tell you, if you had a heart attack, heaven forbid, like the U.S. economy had in 2008, and I'm your cardiologist, I could say, you know what, hit the treadmill. But if the body's not ready to hit the treadmill, regardless of what your doctor says, it's not going to do you any good. And so that's what I think the bond market is telling us, that the neutral rate is lower than we've been used to. And so that is what it is.
Yeah. I think that you and your folks are going to be participants in the debate that we're having. We have people, so what you describe in terms of what goes on in the bank, we have that internally as well, pretty spirited debates around hurdle rates, and it becomes fairly technical in a hurry. So, you know, we're really looking forward to having some of those debates. That would be very helpful. We're going to have one more question, I think, before we wrap it up. So I'm going to hand it over one more time to the room.
Good morning. My name is Todd Schnobrick. Thank you for being here today. Earlier this year, Richard Thaler was given the Nobel Prize, and he's known as the father of behavioral economics. So as a non-economist sitting amongst a lot of economists having the intense intellectual debates you mentioned, how does that play into the work you do, the consumer behavior within the broader economic models and traditions?
I think it factors in a lot, and it goes back to, excuse me, the discussion of psychology. And you know, some economists think that, well, we're all perfectly rational actors and always going to make optimal decisions over the long term. If that were true, we wouldn't have crises, right? We wouldn't do stupid things. But the fact of the matter is, the human species has these mass stupidity events every 50 or 80 years. Right? It goes all of recorded economic history, and we keep making the same mistakes over and over and over again. And we're going to keep making the same mistakes. And that actually is what's motivating our work on Too Big to Fail. Let's accept that. Let's try to prevent them, but let's accept that we're not. And let's put in place a regulatory system that can protect the financial system and protect taxpayers when we have a mass stupidity event again in the future. And by the way, I mean, I participated in it. And I bought a house in California in 2005. I didn't see it coming either, right? So it's something that I think we think about a lot, but we have a lot still to learn.
Okay. With that, we're wrapping it up. You want to wrap it up?
So thanks again for both of you for being here. You know, President Kashkari has been one of the most vocal and transparent Fed presidents we've ever seen. So if you want to read about the 3 times he dissented, why I dissented again, why I dissented a third time, it's on medium.com. can also find him on Twitter. So we thank you for coming. Thank you, Marcel, for joining us. Again, on behalf of the Data Gang, we really appreciate both of you being here with us. So have a safe day, and thank you for those of us that joined online.
Thank you very much.